Welcome back to the channel. I'm Trevor Meyer with Financial Design Studio, and today we're following up our conversation about pensions and what might make the most sense for you, your family, and your financial plan. In our last video, we talked about pensions and figuring out the annuity payments, the lump sum options, and calculating which would actually be the best option for you and your family. Now, we talked through different scenarios where sometimes the best financial option wasn't always the best family option. And if you remember, that came back to the aspect that we are only picking the right financial option when we're being wise with those dollars that we have. Our example previously was if we had $800,000 given to us today versus $50,000 for 30 years, what would make sense for you and your family? Today, I want to actually explore a little bit to say, we now have all of our pension estimates available through our employer, and now we're trying to determine what's going to happen with current interest rate environments and how might those affect any pension lump sum offers that may be offered to us from our employer. Now, depending on your employer, you may have one of two very common pension types available to you. If you work for a company like Advocate, the pension type available to you is called a cash balance pension. If you work for an employer like Allstate, the pension type available to you is called a traditional. Now, why does this matter? This matters because this factors greatly into how these pension amounts are going to be calculated. So let's pick on the cash balance pension a little bit more right now. With the cash balance pension, we essentially receive service credits each and every year. So the company, or the employer in this case, may determine how they're going to calculate these service credits. Generally speaking, it's a factor of the amount that they pay you times the number of years of service that you have. So each and every year, your employer is going to add money to this pension plan, very similar to a 401k match, and they're going to add it directly to your account. You're going to see this account balance grow and grow and grow over time. In addition to receiving the service credits, you're also going to receive interest payments on these amounts. So the great thing with this type of pension is this balance never goes down because this is only ever invested in very safe securities that only earn interest. Now, the downside is you don't get an opportunity to grow these amounts similar as you would with a 401k, an IRA, or a Roth IRA, or any of those account types. So as a recap, we have service credits, and we have interest. Those are the contributions that get added to the cash balance pension plan. So that's how a cash balance pension works. But what about a traditional pension benefit? Now, you may see a traditional pension benefit for much older employers because these were the original types of pensions that used to come about. Now, let's say we have one of those available to us, and let's say our employer is offering us a $2,300 payment a month for the rest of our lives, and that's our single life annuity amount. Now, we can do some math and we can look to see, okay, what is the lump sum offer that might be available? If they're using a discount rate of, let's say, 3%, we could expect to say that maybe that lump sum offer that they would give us is around $950,000 if we wanted to discount that and roll that into an IRA. But as we know through 2022, we know that interest rates have significantly increased this year. So why does that matter? Because interest rates have a direct reflection on the lump sum offer that our employers are offering us. We've actually seen this happen for a couple of clients. And as interest rates continue to rise, so too does the dollar amount that our employers or the insurance company think that they can receive on the dollars they have invested to pay you your monthly annuity amount. So boiling it down, essentially what that means is if we're looking at $950,000 at 3%, what is that number if it's at 4%? Roughly speaking, we could see a number of about $600,000 to $650,000 as a lump sum offer. Now, if we're approaching retirement, that's a pretty significant gap. Whether or not we could actually receive a higher interest rate into the future is directly dependent on our own financial goals, our own financial setup, and our own tolerance for being able to accept risk going into the future. But it's one of the things to be mindful of as we are approaching retirement, because as interest rates continue to rise, and as they've risen this year and continue to rise into future years, this may be a significant factor in how much money we may have available to us at retirement. So bringing it all together, trying to understand how we can retire, when the right time to retire is, and what changes we might need to make in anticipation for retirement are all very critical key aspects. Things that we can keep in mind are, hey, what's our pension type available to us? We know if we have a cash balance and pension available, that lump sum offer is not going to change. But we know for certain years, if we have a traditional pension benefit and we're anticipating to receive the lump sum offer through our employer, if interest rates continue to rise as we've seen this year and perhaps into the future, that may make a significant impact to say, hey, we're going to receive less dollars from our pension offer than we would have anticipated otherwise. There are opportunities where you could say, hey, I'm going to accelerate my retirement, and you can actually earn more money in doing so because you're still being able to leverage that lower interest rate and higher lump sum amount. If you've got questions about your specific financial plan and how this might affect you, what your pension options are, figuring out to say what is going to be the best option for you, your family, and your financial plan, please let us know. We would love to help you. We've got plenty of other resources here on our YouTube channel as well, but most importantly, we just want to be a resource to help you figure out what's going to make the most sense for you and your family. Thank you.